The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Pretty good. How's everyone?
Everyone's doing good. I'm tired of these preemptions, though, this UT football.
Yeah, that's right. We lost, 3 shows this year so far?
I'm telling you. Well, we're on this week.
All right.
Unless they change it. Like last week, I think they called me like the last day. Oh, by the way, you're off again. Okay.
Well, let's make it a good one.
That's right. Remember, we developed this show to answer your financial questions, so that's what we're going to do today. We're going to go over financial questions. What happens is, through interviews on the telephone or in person or emails, if we ever find a question we think is going to appeal to a broader audience, we're going to share it with you. We always don't use names on purpose because we're trying to protect the innocent.
That's right.
And we're going to give you and remember, no question is ridiculous. No question is stupid. Just if you have a question, send it to us. We'll be more than happy to answer it. We won't berate you in any way. And your question.
And if we've answered the question 54 times before, we'll still answer it again.
That's right.
No.
And if you have questions and you'd like them answered personally, you don't want to be on the air, you just
Absolutely.
Don't hesitate to call our hotline, 972-715-2424. Again, 972-715-2424. We need to ring a bell or something. They just announced they're increasing Social Security next year.
Hey!
0.3%.
Before they means test it and dock half the people.
So here's what the problem is. When you're doing financial planning, retirement planning, you got to figure some kind of inflation in there. And you also got to figure cost of living adjustments on Social Security. What they've done is they keep refiguring Social Security because right now inflation's pretty low,
right?
Like 2% or so. But they didn't raise this any last year, and 0.3 for 2017.
Yeah, and I'd argue with that inflation a bit because I know statistically, based on the CPI and all of that, which they add and remove things as they need to keep it at 2%. It shows 2%, but look at the housing market here in Dallas, the grocery store. We talk about your water bill all the time. I mean, it looks pretty inflationary to me.
We're finally seeing what Californians have seen forever. I looked at Zillow on your house. Look at it, it's gone up like crazy. But the only problem is you sell your house, you got to buy another one that's already inflated.
That's right.
You can't win.
No, that's right.
Unless you move to like Arkansas. Take your high value and move to like the sticks in Arkansas, or Alabama or something. You can do pretty good there.
Which is an advantage Californians have had, right? They get this big increase in their real estate market. They sell everything for a couple $1 million in a 2,000 square foot house, and they move inland.
I know. I'm going to see my Navy buddies, and in California, and they we've talked forever. It's been 30 years, and
but you guys keep in touch.
Yeah, we've been talking every year. We talk. We're going to get together.
Right,
finally, I just said I'm just going, and so. But they bought their houses in the Bay Area for like $150,000, which remember back in the 80s, that seemed like a fortune. Same house in Dallas had been $70,000 or something.
Right,
it seemed like a fortune, but now they're $700,000 or $800,000. And what you get there, this is not in San Francisco. This is in the outskirts, in the suburbs.
Right.
But you $700,000 or $800,000, you're going to get 1,400 square feet built in 1945.
Now
that's what you get.
On a side note, we got 3, 4, 5 nuclear engineers getting together. What are y'all going to talk about?
I don't know. Nerdy stuff, I guess.
Now, you are going to California.
We'll actually talk about our glory days when we're all skinny. We all had hair.
Since you are going to California, they're going to have some sort of election party, aren't they?
Oh, yeah. I'm afraid which one.
Exactly.
I remember all of us had that real thick hair, like Fabio.
Right.
Fabio hair. Yeah. Well, we don't anymore. Things have changed a little bit. It's weird when you talk to somebody you haven't seen in 30. Their voice sounds exactly the same.
And you expect them to look the same.
That's right. One of them looks like Santa Claus, and I'm like, look at that. I can't, but their voice sounds exactly the same. It's so odd.
Yeah.
I thought my voice has changed, obviously matured, got deeper, and but it hasn't. It's the same voice I've had for my whole life. But that's what we've got. All right. So Social Security is increasing 0.3%. And trust me, folks, if it ever starts going back up 4 or 5% a year, they're going to refigure another way to screw you. That's just what the government does.
We were talking at lunch the other day about another wave, not baby boomers. I don't know what they're calling the generation, but you said one of the largest generations ever at lunch the other day is coming up again. I wonder how long before they get into the workforce where they'll help start subsidizing some of the Social Security.
It needs a lot.
Right?
We need a lot of people procreating is what we need. They got to pay for our old asses, right?
That's right.
Come on, people. Get together. It's Saturday night every night, right? All right. Let's talk about this scam that somebody tried to scam me. Remember, we're going to let you guys know anytime there's a scam out there, okay? This one was pretty good, though.
Right.
I'll let these guys go because I want to hear this thing, right? Even though I know it's a scam. But this one is pretty good. It was pretty well thought out. They told me, I pay like $200. I got 11 TVs, right? They pay like $275 a month for DirecTV. And they said, hey, we've looked over your DirecTV bill. We're going to give you a special. We're teaming up with Amazon on this promotion. I'm like, okay, sounds legit, right? $69 a month. I was like, for 11 TVs, I got all the movie channels. We're throwing in all the movie channels. And I'm like, well, I already have all the movie channels. Well, then you wouldn't get that because you already get it. But $69 instead of $270. Here's the only catch. You got to pay 5 months in advance. You pay 5 months in advance. You don't have a bill for that 5 months.
Right.
Then you go to the $69. We don't take any money on the phone. You're going to have to call the DirecTV billing office and set this up. And you're going to give them this code. It was DTV, like DirecTV,
right.
017. I'm like, that sounds pretty good.
Legit so
sounds
far.
Legit, right? But the problem was they said, all right, you need to go and buy $350, which is 5 months of this $69.
Right.
A $350 Amazon gift card. It has to be an Amazon gift card because that's who the promotion is. And then you pay your bill with that. Here's the number to DirecTV billing office.
It's getting convoluted now, isn't it?
Here's the scam. They answer the phone, DirecTV, and this was in India. I could tell it was in India or Pakistan or whatever. Right?
Yeah.
They answer the phone, DirecTV, but it's not really DirecTV.
And by itself, with all the call centers, isn't necessarily a red flag.
No, that's right.
In India.
I actually called DirecTV. I go, this is a scam for sure. And they go, there is no such promotion. It is definitely a scam. They called me back to make sure I'd paid that deal. And I go, you're a scam. Who said that? DirecTV. Didn't you call the number I gave you? I go, you're just answering the phone, DirecTV. But it's that.
Oh, yeah.
Anybody can get caught in that. They had my address. They said, you have DirecTV service at this address. I don't know how they got it.
Yeah, one I've had for a long time. You'll get the phone call, and half the time it's automated. I'm calling about your credit card. So you're thinking, oh, no, what's going on? And then as they go on, you realize it's not really your account.
Well, the IRS. The IRS calls, and you're about to get foreclosed on everything.
Oh, yeah, I've had that.
And you got to go down to get a Target gift card. I'm telling you, folks, the IRS will never make you get a Target gift card for anything. Why do they use gift cards? Because they can't be reversed. Like if you use a credit card, you can say, I challenge that.
Yep.
You cannot challenge a gift card. So that's why all of the scammers have gone to gift cards. So anybody tells you anything, you got to go buy a gift card. Remember, they're thieving crooks.
Yeah, be careful.
There's only one thing worse than a thief. I'm not going to go into it, but that's just terrible.
Speaking of thieving crooks, I heard Obamacare is costing a lot more now. Was that subtle?
Nationwide, it's going up, 22, 24%?
Average, but Arizona is like three figures, so almost 100%.
It's like, 40 or 50 in Texas? I mean, it's going up a lot.
Yeah, it depends. But yeah, the average is a 25% rate.
Oh, wait a minute. Obama promised us you can keep your doctor, you'll get just as many choices, and your premiums will go down. Are you saying none of that's true?
I have Pelosi in my head saying affordable, 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 Affordable Care Act. Remember when she got on there for 5 minutes?
Now, remember, if you're a small business owner, okay, these are individual policies. Individual plans in Texas, I think you're down to maybe 3 carriers with high deductibles. It's crap. Like Arizona, Phoenix, the big city of Phoenix is down to 1 carrier, and I think it is $14,000 deductible.
Yeah, it's crazy.
Just a horrible, catastrophic plan that's expensive. So if you're a small business owner, I'm a small business owner, you might think about getting your employees health care. We have some inexpensive plans, much cheaper than the individual marketplace. Because what some people are doing is they're subsidizing the people to go to the individual marketplace, or they just let them go on their own. The number one benefit people look for, employees, if you want to get good employees and get them loyal.
Handcuffs.
That's
handcuffed
right. Health insurance is the biggest thing. And we can do that for you here at Dillon Gage. We can search the small business, small company marketplace. If you have 3 employees, 5, 10, 20, if you have under 10 employees, only 17% offer health insurance. Why don't you be that 17% and you can attract those quality employees and retain those quality employees, and the cost is much less than the individual marketplace. So it's a real benefit that doesn't exist otherwise. You can call us at 972-715-2424. Remember, we do stocks, bonds, annuities, your car insurance, your home insurance, health insurance, pretty much everything but real estate. So you can listen to everything I tell you, but when it comes to real estate, I've never made a penny, so don't listen to me on that piece.
We can do it. We're just not good at it.
Stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. All right, we're going to go over your financial questions now. Remember, if you have any financial questions, or any questions for that matter, don't hesitate to call us at 972-715-2424. You can always go to our website, at ilovemyretirement.com. By the way, there's a lot of great videos on there. There's new white papers that come out all the time on that sheet. Nice articles to have about retirement and finance. ilovemyretirement.com is the website to talk to you.
Are you ready for a question?
I am ready.
All right, here we go. It's been a while. It's been a couple shows, been preempted, so we got a backlog here. Number 1 question. I'm 30 years old and just starting to invest. Where in the world do I start?
The one thing, I'm glad you're starting. The earlier, the better. If you can start in your 20s, start in your 20s. The first thing to always do if you're a young investor, take advantage of your company 401k. If you have access to it, put as much as you possibly can into it. A mistake I see a lot with younger people is, well, my buddy was an Edward Jones guy, and they put me in a mutual fund thing, and blah, blah, blah. They said that was better than the 401k. A 401k had limited choices. I go, well, your buddy didn't do you any favors.
No.
When you take the tax deferment, the tax deductibility part, and potential matching, it is impossible to beat the returns of a 401k.
Yeah, now, and don't get us wrong. You have to have an emergency fund. You need to have, 6 to 12 months actually of bills, but starting out certainly a couple of months, and you build it as you go. But to max out your 401k, like Victor's talking about, that's $18,000 a year. And
at
again,
30, when you're 50, it's more.
Yeah,
right.
The catch-up provision. But if you're starting out at
That's
30,
right. Exactly right.
And if you break that down, that's $1,500 per month. So that's usually pretty painful, especially
right.
at 30. You may have kids, may not. But so you have to kind of do two things. You want to max out that 401 almost to the point of pain, but you also need to get a little emergency fund going, some extra couple months worth of bills, and build on that as well as you go along.
Now, one thing you could do as well is put let's say it's a smaller amount than you want to, but make it, let's say you're a job that typically has a 3% raise a year, something like that.
Yep.
Automatically raise your contributions 3% a year. So you can't start as high because you're young, you got a lot of bills, I get all that, right? But have it go up 3% a year. So in the next few years, you'll be starting to max it out.
Yep.
Because you'll never feel it. In other words, it's just extra pay that would have come in, but you're still living on your normal budget. But that's a really good way. And remember, control your expenses. The best way to save money, control expenses. What's the best way to control expenses? Write them down. Write down everything you spend.
Not get married? Oh.
Not have kids. All that.
Did I say that out loud?
But control those expenses, and you can save a lot more. The people that come to me that started saving in their 20s and 30s, not always, but I'd say 90% of the time have more money at the end.
Oh, yeah.
It's just the way it is. I mean, you've seen a chart. If you start in your 20s or 30s, it takes like a third as much as if you start in your 40s or 50s.
Well, if you make 7%, your money will double approximately every 10 years. Well, 10 years, it's doubled, right? 20 years, it's quadrupled. 30 years, it's up eightfold. And
Right.
if you didn't do it for the first 10 years, you're not up eightfold, you're up fourfold.
That's right.
And it's a big deal.
Oh, yeah. Especially when you start getting from 20 to 60 numbers.
Oh, yeah.
It gets really crazy.
Absolutely.
And so that's what I said. Absolutely. When you max out the 401k, some people do that. They get a good job when they're younger. Then you can start investing. What I would invest in now, you still don't need a broker at this point until you get a few $100,000 under your belt, because the options start opening up to you then, managed accounts, etc.
Fees come down.
That's right. Stick with index type funds or ETFs. Those, you don't need to pay retail mutual fund fees. Some of these retail mutual funds have fees hidden in there of 2, 3, 4% a year. Doesn't matter, the management fee just says 1.6. There's other trading costs and soft costs in that mutual fund that can destroy the returns over time. Like I said, I'm not a big Vanguard supporter, but I'm telling you, for a young person, they aren't bad. I like that company. I think buying ETFs, I like ETFs a little bit better than index funds just because they're a little more liquid.
They respond quicker. That's right.
Yeah. So I like those. And now the fees have come down, so they're about the same. So I'm a big fan of index funds. Always have been, always will be.
And
I
I've
think I said
seen
that right.
I've seen new people starting out, and we'll help if you have any questions. Certainly, feel free to give us a call. We do it for our clients' children and nephews and all sorts of things. But usually, when they're getting started out, and you look at their choices, their options that they've got at their company, and it's a small account, usually they put a little bit in every mutual fund, because they're thinking it's diversity. And what Victor's talking about when you invest in the indices, whether it's the S&P 500, you've got 500 companies, there's not much cost, right? Because you're not trying to buy and sell and trade. Only if a company gets delisted and replaced is there a transactional cost on that. You don't have to worry about one mutual fund owning Apple while the other is selling Apple, and they're contradictory. So just having a piece of all the mutual funds available to you in your 401k may not always be the best
I've seen
thing.
an overlap of 80%.
Yeah.
Same exact stocks on an index fund paying 0.1.
Yeah.
On a mutual fund paying 1.6.
That's
It's
right.
like, yeah, you bought the same thing, you just paid more for it.
And if a broker's helping you do that, then you really need to be concerned.
All right, what's the next question? Yeah.
All right, next one may be long. Let's see. I like the idea of getting a guaranteed income stream for the rest of my life, but I've read so many things that say annuities are bad. I know you're a fan, but how do I know that the detractors aren't right?
Okay. Well, it depends. Honestly, it's usually me against them. In other words, remember I got in this business? I was on the stock side. Stocks and commodities. Stocks good, annuities bad. And that old guard still exists, even though it's very, very smaller now. We got a break coming up. We'll go over that question
We'll do it
again when we
again.
get back. Remember, if you have any financial questions, our number is 972-715-2424. Go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome to the show. Today we're going over your financial questions. Guy, would you read that one question again?
Yes, we started this before the break and didn't have much time. All right. I like the idea of getting a guaranteed income stream for the rest of my life, but I've read so many things that say annuities are bad. I know you're a fan, but how do I know that the detractors aren't correct? They're not right.
All right. Remember, it used to be, they didn't have anything called financial planners, financial advisors, really, back then. There was such a small percentage, they almost didn't exist. You had stockbrokers. And stock guys would say the insurance guys, they're crap. Oh, yeah. Insurance guys would say stockbrokers, that's like the casino. What, are you going to gamble your money away? Both of them were wrong, right?
Yep.
Now it's all pulled together. So a lot of people are still that old guard where annuities are bad. Annuities have changed so much in the last, we've been doing this 30 years. In the last 10 years, annuities have changed a lot. In the last 20, they're completely different. You still have those old types, right? And what they'll do is if you're an anti-annuity person, you'll take the worst one. Remember, there's 4 or 5 different types of annuities. Only one has high fees. That's a variable annuity.
And risk.
That's right. So what they'll do is take that one and say, why would you pay somebody 5% in fees? Don't touch those annuities. I agree with that. There's no way I'm paying somebody 4 or 5%. Are you kidding me? Impossible. But all the rest of the annuities have little to no fees. Okay? And it just depends on what your objective is. If your objective is to get the most income, well, in the environment we lived in for the last 10 years, nothing will pay more income than an annuity. And that's why they're so popular. You'll hear detractors say, well, it's because they make big commissions. That's the only reason they're selling. That's not true. You make more money on managed money.
Well, and it's a guaranteed product. I hear an awful lot, oh, they don't make very much. And that's not accurate, too. We've talked about it before. We used a toolbox, if you will, as an example. And you know what? Your basic tools are what? A screwdriver, a hammer, a wrench, and a tape measure. They all have specific jobs. Do you need every one of them for every job? No. But if you had a handyman come to your house, oh, nope, I never use screwdrivers. They're just not my thing. They don't work right. I use pliers all the time. You wouldn't hire them. It's the same thing with investments. These are specific. They're tailored to do certain things, and what they're tailored to do, they do very well.
Right. You get it. It's hard to get an objective opinion. Like Ken Fisher is the big anti-annuity guy, right? He's trying to sell you a managed program.
Millions of dollars.
Everything's evil but his managed program, right?
That's right.
Come on. But people believe it. So what you can do is detractors always have an objective, okay? I've got Harvard professors, MIT professors, Yale professors, all of these different academics that say, hey, you should consider this. A lot of them, but they don't have an agenda. Right?
They don't have the airtime that
That's
Ken
right.
has.
They don't have the agenda. They're not spending $100 million a year in advertising. But I just see through it. There's nothing wrong with legitimate investments. Just like Guy said, they're different tools. If you want the most income, annuities pay more than anything. I'll give you an example. Right now, $1 million on a CD, $10,000 a year. On a 10-year investment grade bond, $20,000 a year. On a government 10-year bond, $15,000 a year. Well, the annuity can pay you $50,000 to $90,000 a year. That's why people are doing them. It has nothing to do with somebody's opinion. It's math. All right, I can get more income out of this. Now, does that mean it's perfect? No. You have to take everything by itself. But there's the problem with being low interest rate environment, it's great for your house, right? It's great for moving real estate or getting a loan. It's bad for everything else because you can't get any interest on your money. There's 3 unknowns that you have when you get close to retirement. They'll scare the hell out of you. The first unknown, you don't know what your investment returns will be. So how can you plan on, right? You don't know how long you're going to live. And you also don't know how much you're going to have to spend every month.
Or healthcare costs.
That's right. And so all those unknowns, especially for a lot of people, I'm a control person, right? I've known everything. I've got my bills down to the penny. Yes, I still balance my checkbook. And a lot of people don't balance their checkbook anymore. How do you balance your checkbook? Well, look at the statement. What? How do you know the bank ain't wrong? Not that I've caught the bank wrong a lot. I have to know, right?
You only have to catch them wrong once, and it justifies what you've done. But
so unless you have you're a Swami or some clairvoyant, you're not going to know when you're going to live. That one you can take off the table. But you can figure out, all right, how much you're going to have to spend, and you can get a guarantee or some kind of guarantee on maybe not know what your investment returns will be, but you know you can't lose anything.
There'll be
you can do 2 out of 3 of those.
There'll be instances where this income stream or a fixed annuity won't be appropriate for you. There's also instances where managed money or mutual funds or an indice fund of some sort won't be appropriate for you. But one thing that Victor and I will give you our word on, if something is or isn't appropriate, we will absolutely tell you, show you exactly why, and we've got a wonderful program that does that.
Right. What we do is, we do our retirement analyzer, which shows you your current trajectory. We're going to add inflation in there. We're going to stress test the portfolio, and then making these changes, what it actually does for you mathematically. No emotion, no nothing, no opinions. Just here's what it does for you. And if you have a chance where you could run out of money at 80 when you retire at 65, you need to look at options. And we're going to show you those options that protect you against living past 80,
Absolutely,
which is a pretty high thing now. Call us at 972-715-2424. You can set up a no cost, no obligation consultation, or you can call us for the financial question. Again, 972-715-2424, or go to ilovemyretirement.com. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the show. The one thing we've always prided ourselves on here at Dillon Gage is giving you objective advice. All right? Remember, we are licensed in all the different areas. We're not some insurance person pretending to be a financial advisor. How can you be a financial advisor if you're only insurance licensed? That means every single person you're going to put in an annuity or life insurance policy, regardless if it fits. It'd be a square peg going into a round hole. We're going to put you in there, and we're going to show you that everything else is bad.
We're going to make it work.
That's right. It's all bad. Don't do a CD. That's bad. Nothing wrong with a CD. Just not paying much.
That's like a lot of times we'll have a client transferring funds, and without knowing anything about the client, right? They say, I need to transfer my funds. Well, first thing they do is go into conservation mode. Oh, no, can't transfer your money.
Whatever you're going to do, don't do it.
But without asking any questions, you may be talking to somebody that you've never talked to before, not an advisor, and all of a sudden he's going to come up with some great ideas for you. He knows nothing. How many kids you have, how old you are, when you're going to retire, how much money you make, and they've got ideas for you.
I tell every client, I go, think about it. When you plan to do something, that advisor has no benefit to tell you it's a good idea.
That's right.
He's losing the money, right? He's not going to tell you that's a great idea. Why didn't he come up with it, right? There's no way. No matter what you do, they're going to say it's a bad deal. It's a bad idea. But think about it. When I do a plan, I've spent 4 to 10, 12 hours going over your particular situation. We ask you very definite questions or,
in-depth questions.
Right, in-depth questions. And we go over we put inflation in there. We put any kind of potential cost of living adjustments. Let's say you have rental properties. You're going to raise that 3% a year in rental income. We're going to put all that in there. So we've gone into great depth to show something that suits your situation the best. They'll call you. I mean, you're calling for the transfer, and they're going to give you advice. They don't know anything about you. You're just a number on a screen. It's just their job to conserve any accounts. So I've even talked to people at those places, and they said, well, yeah, we don't know much about it. We just tell them it's bad. And we'll keep about 25% of them just by saying that.
The fun part of our job is to sit down with you guys, with our listeners, and go through this. And we use the financial analyzer and the plan, and we'll add annuities and remove them, and add mutual funds or manage money and remove it. But what we're able to do, and the fun part, is showing you the options based on what you need and working with you to pick out the right one so that you can have the retirement that you need to have.
Right. If you'd like our no cost, no obligation retirement plan, call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com.
You ready?
The contact us button.
Sorry. You ready for another question?
I am.
All right, here we go. I've been investing in dividend-paying stocks for years with good results. Why don't you discuss this strategy for providing someone with relatively safe, consistent income?
There's nothing wrong with dividend-paying stocks. The only problem is just like the problem we have with anything with income-producing stuff now. The S&P 500 is down to about 2.1. It's got down to 1.5 just not too long ago. But 2.1 yield, that's okay. What happens is the problem we have with dividend stocks is everybody goes for higher yield. I don't want the 1% one. There's a 5% one right there.
You get 1% in a CD.
That's right. That's ridiculous.
Without risk.
I want the 5. And so many people have done that they have ran the valuations of these stocks to catastrophic, huge levels.
Right.
And so they are very risky at this point. And that's what you have to worry about is how risky is this thing? And now, some people say, I don't care. I'm always going to get the dividend, right? I'll tell you what, you put $1 million in that thing and you lose half of it, you're going to care.
Nice dividend, though.
I know.
Because if you got half the money getting the same dividend, right. It's a big dividend.
What was the biggest dividend producer 3-4 years ago?
I would say the one that always comes to mind for me is ConocoPhillips.
Energy stock.
Absolutely.
That's right. Energy stocks. What happened to them?
Yeah, not so good.
But everybody goes, we're always going to look. China, they're using up all the oil. Remember back then?
Oh, yeah.
The Indians, they're using up more oil. They get in the middle class. Well, how come it crashed? That can't happen, is what they said. Just like they said real estate can't go down anymore.
Yep.
They're telling me that right now.
You remember back, I'll bring an old one. Remember back in the 90s, Vic, 95, 96, we used to use Black Warrior Dominion Trust.
Oh, yeah. Yep.
What was that paying at the time? It was 17?
14 or 17.
Yeah, it was great for a long time.
But so what's happened is, so these companies have done this, right? And the big bellwethers to get the higher income is going to be your utilities, your technology, and your energy companies. Well, we already know what happened to energy companies, right? All the oil and gas ones used to be paying really good. Now they're paying crap, or you just lost your money. But the PE ratios on utilities is up to 18 or something right now. which is 25% higher than it's ever been in history. What does that mean when your PE gets too high? It could crash.
What goes up?
That's right. Now, the energy sector's PE ratio, let me get you this one, is 65 times earnings. 65.
That's going to leave a mark.
You tell me there's no risk in that thing?
No,
Because what they'll say is, well, I don't think oil can go below here. Well, the hell it can't.
Yeah.
It can go anywhere it wants, So that's the problem with investing too much in dividends, is they're not guaranteed. It's not consistent. You can't get it. People all the time, what about AT&T? I'm buying that one.
Oh, yeah.
All
Blue
these
chip.
companies they're merging with don't necessarily help their bottom line because they have to pay more than the company's worth to actually take it over and stuff, right?
Yep.
And they have to absorb that the first few years. So those dividends could very well go down. They go down a lot.
I tell you, one warning. Are you through the article? You got a few more things.
Go ahead.
No, one warning I'd like to have is you're seeking yield and dividends, and maybe we'll talk about it after the break a little. But these REITs, especially unregistered REITs, they offer you a 7% rate of return. It gets confused with dividends.
Yeah.
The asset's hard to get your money. Your principal's hard to get back. Just be careful when you're seeking high yield. There's a reason.
Right. Private REITs are not paying dividends. It's paying rental income or whatever.
Right.
But they have total control of how much they charge you for management.
And when you
how
get your
much
money back.
And they can just say you never get your money back. All right. That's our question there. Remember, if you have any financial questions or you'd like to take advantage of any of our free no obligation services, call us at 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome to the show. Remember, if you have any financial questions, you'd like to take advantage of our free no obligation retirement analyzer, portfolio review, stress test, Social Security optimizer, or you just have any financial questions, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. You can go to ilovemyretirement.com.
Dang, we sure offer a lot of stuff, don't we?
Oh, that's right.
No, I'm telling you. All right, you ready for another?
All right, next question.
All right. Oh, here's a $1 million question. I'm going to hold you to it.
Uh-oh.
We're going to dig for that answer. I've read that some people think the market is going to crash and some think it's going to keep on going up. What do you think?
The market will crash 36% in the next 90 days.
Can you be more specific?
I have no idea. Anybody ever tells you they know what the market's doing, run, because that's a crazy person.
Yeah.
They have no idea. I can tell you that we've had 6 negative earnings quarters in a row. 5 or 6. I can't remember, 5 or 6. Last time that happened was December of 2007. What happened in 2008?
It wasn't good.
Nothing
People lost
goes up
about half of their, or 40% of their retirement accounts.
Nothing ever goes up forever. Now, people, I get this confused all the time. I pulled a chart at our weekly meeting, and because the market's gone up, it keeps going up the last couple of years, it's made insane profits. Market hasn't made a penny in 2 years. It was up to 21 something on the S&P at the beginning of January 2015. It's at 21 now, maybe 21.30. So that's over 2 years, like 1%.
That's
it
right.
hasn't made anything, but it did go up. Remember, it crashed in 08. So you got 09, 10, 11, 12, 13, 14, went straight up.
And this year, make no mistake if you're kind of confused, because you have heard them all tell you that we've made new highs several times.
If you look at the chart, you'll see every time it did, because it's been spiking back. It's just been going back and forth off those new highs.
We're at new highs.
That's right. New highs. But also don't confuse the Dow with the stock market. The Dow is just 30 stocks, right? The S&P is 500 stocks, but it represents 80% of the total value of the market. Much better indicator what the market's doing.
And we're not proponents of trading your account. So if you're asking this question because you want to know if you need to get out and get back in, that's not really our style. We rely a lot on our financial analyzer, which we've shared with you and be happy to do for you. And what that does is it helps us set up a long-term plan. Based on your age, you'll have the appropriate amount in stocks so that you don't have to worry about coming out and going in and stressing. You'll be able to sleep at night. You'll have the right amount set aside for income, for retirement, for a pension like the jobs you used to do. You can't find those jobs anymore, can you? So all of that will be taken care of. So if you're trying to, we've seen, Victor, some of the best and had them here that traded accounts. It did great for 4 or 5 years in a row, back tested, but inevitably the market shows them something. And so if you're trying to time the market and you're wanting to come out, if you come out, it's going to keep going up. If you stay in, it's going to go down. So you got to have everything proportioned properly.
And our plan is totally different than the ones you see at the wirehouse, the big firms. All they're doing is a Monte Carlo simulation.
That's right.
Which takes an account in and out of the market, and they put a mutual fund in there or a managed account in there. And all it'll tell you is every time, believe me, they put you in this stuff. They can't tell you it's bad, right? They go to, you'll be fine. If you look at the Monte Carlo,
probability.
The probability is you're going to be fine. No problems whatsoever. Keep 100% in the stock market. You're fine. All it told you was if it keeps making 8% forever, of course you're fine. That's not what you want to make a plan on. Something making 8-10% forever, because that inevitably will not happen, right? What happens if it doesn't do it? That's what you need to know. What happens if things change? Because the market, if you look backwards, you can say, okay, if it never did this, the worst it ever did is this, right? That gives you some kind of look at the future, right?
Sure.
But what if it shows you something completely different, which the market does all the time, right? It does it all the time. It shows something different. So that's why you have to have a plan that's stress tested, okay? Not pie in the sky. So I had a guy with $5 million portfolio. He goes, hey, I only need $200,000 income. They just told me as long as I stay where I'm at, making 9% a year to be fine.
That's right.
I go, oh, really? You mean you're making $450,000 a year?
That's right.
You're only spending $200. Hell, I could have told you that without a computer. That's the dumbest thing I've ever heard. But yet 90% of every advisor out there at every firm uses that exact same thing. Here's a probability analysis on what your money will be. So, well, you got a 69.2 probability of this, 99.2 for this, blah, blah, blah. 90% chance of not running out if it stays exactly the same as it always has. They don't talk about that part. Having all your money in stocks at a certain point, does it make financial sense?
I want to back you up. Did you run a financial analysis on that account?
I did.
How much did it take in fixed annuities, and how much was he able to keep in the market so he didn't have to worry about it?
It was 75% in the market, 25% in annuity. Guaranteed he'll never run out no matter what the future holds on the stock side.
That's what I wanted to hear.
It's about 25%.
Yep.
And it depends on the person. Sometimes it's 5%, 10%. Right. Sometimes it's 45%.
Sometimes it's 50%. Yeah, I've seen some bigger ones.
So that's what you have to do is it has to be stress tested. And we're the only ones I know that are actually doing this. It's an in-depth analysis. It shows cost of living adjustments on Social Security. It shows inflation to things that are inflatable. Like your mortgage, your principal and interest payment is not inflatable.
Taxes
but your
are.
taxes sure are.
That's right.
And the insurance sure is. And so we put all that stuff together for you to show you. Let's say your house is going to be paid off at a certain time. How does that affect your finances? You'll get a broad just by doing simple math. But you need a detailed perspective, and that's what we offer. Remember, if you would like to take advantage of that, our number is 972-715-2424. Again, 972-715-2424. You can always go to I Love My Retirement. You can look around there at the videos, click Contact Us. We'll be more than happy to talk to you. I want to thank everybody for listening today. I'm Victor McClure for Guy Allard. We always, always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.